If you're like most other retiring homeowners up here in Canada, you'll likely want to stay in your home for as long as you can. Age in place, as it's come to be known. 93% of Canadians 55 and up want to do this, according to this study from Home Equity Bank. It's entirely likely, just demographically, that you happen to also have bought a golden lottery ticket called Canadian housing back in the 80s. And now you hold on to an asset of significant worth. But many retirees find themselves sitting on this valuable asset and they fail to realize its full potential. Right? They find themselves house rich but cash poor, with limited funds to give themselves the life that they want while staying in the home that they want in their retirement. Essentially, they're running out of time, as directly insinuated by this Deloitte report, appropriately titled, which found that 55% of near-retiree households will have to make lifestyle compromises to avoid outliving their savings. So if this is you, what are you supposed to do? What are your options? So in today's video, I'll explore the different ways that you can release the equity from your home to enhance your retirement lifestyle. Specifically, I'm going to park on reverse mortgages, who they're best suited for, how they compare to other options that you've got available to you, and even some of the behavioral biases within the professional advisor community that might lead you to be getting suboptimal advice as you think about the best way to release the equity from your home in retirement. Preet Banerjee, a columnist for the Globe and Mail, hit the nail on the head in this article on home equity release strategies. In his words, younger Canadians can't get in, and older Canadians don't know how to get out. We've got ourselves a good old-fashioned Canadian stalemate. In his article, Preet highlights the 7 different home equity release options available to Canadians. 1. Home equity lines of credit. 2. Second mortgages. 3. Refinancing. 4. Selling to downsize into a smaller owned home. 5. Selling and moving into a rental home. 6. Selling to a leaseback, the same home. Or 7. A reverse mortgage. Now, there will be pros and cons to each of these options. Some are pretty basic and easy to understand, while others are trickier or even kind of muddled in mystique. So let's start with just picking option 4, the traditional downsize into a smaller owned home, and illustrate out how this works when baked into a financial plan. So here is a classic case. We've got Tim and we've got Tam, right? They've got just over $1 million of savings and they've got $1 million in their home. And when we ran their plan, we had their income coming from a bunch of different places, a little bit of RSP, a little bit of CPP, a little bit of OAS, actually drawing down their TFSAs at the end of the plan. But the problem was that by the late 80s, by the early 90s, the plan had showed that they were running out of all of their liquid funds. And this was based on about $90,000 of net after-tax spending, inflation adjusted, for the rest of their life. Again, they're about 65 years old right now. Now, one way to obviously remediate this is to have them downsize a little bit earlier. So in this next version of the plan, what we showed is them incurring a downsize move at the age of 80. There's going to obviously be some transaction costs when they do that we've got to account for in the plan, right? They've got to pay property transfer tax, legal costs, pay the real estate agent. And so all of that has to kind of be factored in and come off, which is why the plan actually steps down here on a net worth basis. But this actually still works. They're no longer running out of money. They've got cash left in the bank, albeit a small amount, plus the value of their home when we run this out to their life expectancy at age 95. So that's just an example of how option 4 could look when implemented in a financial plan. By the way, if we haven't ever met, my name is Steve Willems. I'm a wealth advisor out here in BC with the Willems Wealth Planning Group. We started this channel to help you plan for your own retirement, helping you think about and plan and arrange your investments, your income streams, and ideally pay less tax along the way. Now, the one method on this list that's probably the most misunderstood is this last one, the reverse mortgage. If you're like many people, often your guard would probably go up when you hear about a reverse mortgage, and for fair reasons. In the US, much of their historical housing instability has been wrapped up around sloppy, kind of unregulated uses of housing debt. But up here in Canada, that's not as much the case. The product itself is actually different. The regulatory regime is different. In the right circumstances, it can actually be the right tool for the job. So let's start with what those circumstances would need to be for this to make sense. So let's just be clear. A reverse mortgage is different than a conventional mortgage. So with a reverse mortgage, you'll have a loan secured against the value of your home, but you don't need to make monthly mortgage payments. The interest on the loan actually just accrues. You'll always maintain title and ownership of the home, because the lender doesn't want to be in a position where they're having to kick you out of the property they will actually limit up front how much you can actually borrow. It's called like a borrowing ceiling. And this is going to be up to 55% of the value of your home in the form of tax-free cash that's made available either in a lump sum or in regular deposits. This is only going to be available to Canadians who are 55 years old or older. And the younger that you are, the less borrowing ceiling they're going to make available to you, since you'll be growing a liability for potentially a longer period of time versus say someone who's 80 years old and max they're going to be living in the home for maybe another 10 years or so. So most folks who put this in place will have low taxable income. They're typically retirees. And so another perk is that you don't need to qualify for this loan on the basis of income to have it set up. The key ingredients are a mostly clear title on a property that's your principal residence, and you've got to be over the age of 55. So to see if this might be a better fit than, say, a HELOC or a home equity line of credit, let's just quickly compare the two. So a HELOC won't have that age restriction like a reverse mortgage will, but a HELOC will ask you about your income, your credit history, a pile of other factors, your income history, all of that. A HELOC is also technically a demand loan that can be called by the bank or not renewed depending on changes to your income or your home value or your credit score or late payments. So there is some risk there on the HELOC side. In contrast, a reverse mortgage is not callable. There's no risk of the loan being called provided certain property requirements are being met, right? You got to pay your property taxes. You have to maintain the place reasonably, that kind of thing. Reverse mortgages also have no negative equity guarantee, which is to say that you'll never be in a position where you owe more than your home is worth. The lender actually guarantees that what you may have to pay in the future due date will not exceed the fair market value of your home at that time. If for some crazy reason the home value depreciates and you end up owing more than your home is worth, the bank is going to be eating that difference, not you. A HELOC doesn't have that assurance. Importantly too, a HELOC will require monthly minimum interest payments, while the reverse mortgage won't require any of those ongoing payments. So we found that there are a few situations where this can fit in really nicely. Number one, if you live in a condo and you face kind of an upcoming levy without access to liquid funds to cover that lump sum cost, this can make sense for you. Likewise, if you need to fund further repairs on your home of a non-strata property, maybe you need a new roof or a new driveway or a new HVAC, a big ticket item, this could potentially work there. Number two, if you're a grandparent and you're seeing your grandkids leaving, let's say BC for Alberta, you can kind of give with a warm hand, as they say, and pull forward an early inheritance with this method to gift them significant kind of tax-free dollars now and help them get into the housing market now while you still have the joy of kind of having them around and seeing the effect of that gift today. A third, if you're short on retirement income, maybe as a result of inflation, these gradual monthly draws can also be suitable here. They'll come to your bank account tax-free since it's coming out of your principal residence. And so this can help you kind of maintain that current standard of living, maybe enjoy those outings with friends or maintain financial independence and actually be able to keep up with the cost of living. A fourth, if you're looking to do a downsize, but you want to wait maybe for the perfect property and not be in a position where you're going to need to, list your place immediately after you find a new place. What you can do here is you can split those two transactions with this kind of equity release. So let's say you're in a detached home and then you find a condo penthouse that you love. You're maybe a little bit more particular at this stage of life. It needs to be just right. And so you use this kind of financing to make the purchase secured on your current home without needing to sell other assets to complete the purchase. You could potentially then put in maybe even a renter into the new property, that condo penthouse, and just hold it for an overlapping period of time until you're ready to actually make the move and sell your existing place over into the new smaller place. Now, there are a few things to be aware of here, though. First, this doesn't work on land leases, so like long-term native land leases or on mobile homes. It does work on ALR land or land with an agricultural requirement, so long as it's not some kind of massive farm operation, it'll still work. You'll still have a fixed or variable interest rate decision to make on a product like this, just like conventional mortgages. If you still have an existing mortgage, that'll have to be paid off with a reverse mortgage fund, since this needs to be kind of the front of the line. So you'd have to pay off your first mortgage with a reverse mortgage funds, and then the remaining proceeds can be used however you might wish. Importantly, this income is coming to you essentially as a repayment of equity. And so this strategy isn't going to affect any government benefits that you might already be receiving. So OAS or CPP or Guaranteed Income Supplement, GIS. Up here in Canada, one of the biggest players in this space is called CHIP Reverse Mortgage from Home Equity Bank. They've got a few handy calculators on their site that makes it easy to kind of play around and see how this might work for your situation. At the end of the day, though, you'll want to have their analysis integrated into your larger, broader financial plan, just to map out how this will interact with all of your other financial decisions in your future. Let's remember, you're growing a liability with this approach. So the interplay between this decision and the ripple effects that it's going to create, they need to be carefully modeled. And to their credit, CHIP requires that you do get independent legal advice, or an ILA, before you'd sign on to their offering. So they'd agree. They just want to see the folks that they're working with get good, rounded advice just to make sure that the strategy actually makes sense for their specific situation. I mentioned at the start that some biases in the professional advisor community tend to paint this option as being unequivocally bad, kind of like a ticking debt bomb. There's probably a few reasons for that. Just a poor understanding of the product, perhaps maybe misaligned incentives. But as you can see, largely due to good product design, there's safeguards up here in Canada to protect those kind of catastrophic blowout scenarios that someone might imagine. And so for many, it's actually a decent option, one worth kind of putting on the table and worth considering. Tapping into the equity of your home is becoming an absolutely growing trend. So if you find yourself caught in this quandary of being house rich but cash poor, you've got a handful of choices, all with different consequences. Hopefully this kind of helped prime the pump as you think about your pathway and which one might be suitable for you. I'm curious though, have you ever considered kind of baking your home equity into your retirement plan? Maybe which of these 7 options seemed like the best path for you? Write in the comments. I'd be curious to kind of hear what you think. Otherwise, that's all for now. Thanks again for watching. I do appreciate it. See you in the next video.